Hi everyone, it's Blessed Emmanuel here, and in this video we are going to look at what is liquidity and types of liquidity and how to spot liquidity on the charts. But before we dive into it, let's take a look at the disclaimer and the intro. Okay, so welcome. So we'll start by looking the types of liquidity. First of all, what is liquidity? Um, Liquidity, this is actually the area in the market where money is lying, the area where money is lying in the market, or where the market movers, these are the banks and the big investors, target, where they target in the market. So this is where these people are targeting in the market. And the reason as to why they are targeting, it's because the stop losses of retail traders are lying at these areas. So we'll take a look at specifically which this area, how to spot these areas on the chart so that you might not be stopped out. Yeah, so while you are trading, you need to be so careful with these areas. So we'll start by types of liquidity, and in this one I'll only explain four major types of liquidity. So we'll start by number one is the area above any high or any low. Yeah. So area above any high or any low. Like if you can see here, we have this high. This one is a lower high, and this one is a lower low. So any area above any high, the area above any high is a liquidity. The area above any low is a liquidity. Below any low is a liquidity. So that's number one. The area above any high or below any low. And we'll look at it on the live chat example. So for now, just know that above any high or below any low, that's a liquidity area. Yeah. Then we also have equal highs and equal lows. Equal highs and equal lows. So, for example, here we have this equal high. Uh, a retail trader somewhere is viewing this equal highs as a double top. So, whenever they trade, they put their stop losses just above those highs. But the banks know that retail traders are trading this way. So, what do the banks do? They actually move the market towards this area. They now pretend as if they are selling. Then, unfortunately, they stop all of them out before now going to the actual direction where they wanted to go. But before that, they make sure they stop out these traders because their stop losses are lying just right above those equal highs or those double top. Another one is we have equal lows, as you can see here. So for equal lows, uh, a retail trader somewhere is viewing this as a double bottom. Yeah. So when the trader enters a trade, they put their stop losses just below these lows. And what the banks will do, they will move their market toward this zone and they now pretend as if they are selling. Then boom, they take all of them out before now going to the direction. which they wanted to go. Yeah, they come here, they pretend as if they were buying, but then before that, they stop them out, then make a good change of character, then they now go bullish. So these are the types of liquidity: equal highs and equal lows. Those are the second type of liquidity. Then we have the third type of liquidity, which is the trend line liquidity. Okay, for this, by the time we look, I mean, on the live chat example, it will be very easy for you to understand. But for now, I'll just show you how the retail traders or just the normal traders do enter using the trend lines. So they do mark out the trend lines, maybe a series of high lows. They draw a line. That's what we call a trend line. Then they wait for a retracement to that line. Yeah, they wait for a retracement to that line. So when price comes to that line, like for this is an uptrend. When price comes back to this line, because it's their trend line, they now want to sell. I mean to buy, because um, prices now tapped on their trend line. But the banks already know you're trading this way. Yeah. So the banks will give you a false confirmation at this area. Then they stop you out. Then someone will say, okay, I've been stopped out, but the market will come to retest this zone. So they now start trading break and retest. But what the banks do, they come, they go inside their trend, then boom, they buy. They actually buy. Yeah. So this one is a form of liquidity, trend line liquidity. That's in the case of an uptrend. So in the case of a downtrend, here we go. In the case of a downtrend, the trader marks out a series of lower highs. So they wait for price to come and tap on their trend line. Then they wait to buy, I mean to sell. So what the banks will do is actually come here and give them a confirmation. Most of the time, which is okay, it may work at times, but that's how the banks trade against you, against retail traders. So it gives a false confirmation that it wants to sell, then boom, it takes them out. Then it actually comes back and now they sell. Yeah, they now sell. So that's a type of liquidity, the trend line liquidity. We've looked at that was I mean area above any high and below any low. That is a liquidity. Then equal highs and equal lows, or you can call them double tops and double bottoms. Then we've actually taken a look at trend line liquidity. So now let's take a look at the fourth type of liquidity, known as supply and demand liquidity. Yeah, I have a real, a short, as most of you would like to call them. It just resembles this. It shows how traders are induced. Yeah, those who trade supply and demand, how they are induced before actually price taps into the supply or demand zone. Yeah. So yeah, we have a demand, a supply zone here. So price comes, but before it taps into the supply zone, it now starts selling. So a trader with a fear of missing out will now enter that trade because yes, it hasn't reached the supply zone, but it has started going to the downside. A trader who is not patient enough will now sell. So what happens next? They come now and take them out. They stop them out. Now before it now taps into the supply zone and now starts going to the downside. Yeah. This is what we call inducement. They induce you to now get into a sell trade. If you fall for the inducement, then they stop you out before they now actually start going to the downside. Yeah. The same applies with the same applies with the demand zone. So for the sake of, in the case of demand zone, price comes before it taps into the demand zone, it starts buying. Yeah. So this is just an inducement or a liquidity. This is a type of liquidity. So this is where money lies in the market. They induce you, you now start buying. But all of a sudden you are stopped out before now price starts going your direction. So those are the four major types of liquidity. Uh, I hope this video has helped you. Now, if you're able to spot liquidity in the market, it will be so easy for you to trade and avoid being stopped out. It will also help you to improve on your patience as a trader. Yeah, I, I will create part two of this video. Make sure to check it out. So if you have reached this far, be sure to like the video, share it to the other traders, and also subscribe to the channel. Yeah.